All right, I have decided to trim my position in Tattooed Chef TTCF. Trim, not sell out of completely, not exit, but just trim and sell a few shares of my TTCF in my portfolio. And I have a pretty interesting strategy here in this video that I want to explain to all of you. It involves a bit of options where I can kind of squeeze or milk out a few more dollars or a bit of extra gains while I'm selling the stock, or if TTCF were to fall or downtrend in the coming weeks, I would still be able to make money on my TTCF shares. So let's get into it. So in my most recent video on TTCF about maybe a week or 2 weeks ago, I explained why I would like to still own the stock, but perhaps why I wouldn't want to make up such a large position in my portfolio, as my conviction has been reduced slightly over the last few quarterly reports. But I'm not going to be making it like a puny part of my portfolio. It's still going to be sizable. So right now, Tattooed Chef, this is actually 506. This is my third time recording this, but this is actually how many shares I own of Tattooed Chef right now. And this is a live portfolio tracker that updates in real time all of my portfolio positions, all the gains and everything, the latest buys and sells, market value, cost basis, all 17 positions that I currently own. And if you're in investor community, which is linked down in the description below, you have access to this 24/7, of course. But yeah, so right now, you can tell based on the spreadsheet that Tattooed Chef takes about 7% of my portfolio allocation. And if we reduce that by 100 shares to 406, then conveniently it gets a bit closer to 5%, which is more where I would like it to be. The reason it's convenient that it's a difference of 100 shares is because we're using an options strategy. And that's the way that I can make money while waiting to sell my 100 shares of TTCF. So this strategy is what's called selling a covered call. So selling a covered call, I'm going to explain what this means. This is the actual trade that I made today and posted to investor community. Again, they'll get all my buys and sells in real time. Again, linked in the description below. But if you have no idea what I'm talking about, if this looks foreign to you, do not worry. I'm going to do my best to explain it in this video. But essentially, this strategy allows you to make money while stocks are falling, or in this case, squeeze out some extra gains of a position that you'd like to exit or trim, but where you're not necessarily in a rush to do so. So I'm going to show you an example of a live trade I just made, which is this one, because I think, one, it promotes transparency and finance YouTubers to kind of show what we're doing behind the scenes, what trades we're making, and two, it's an opportunity to learn about an investment or interesting options strategy. So we'll start with the basics here. Later in the video, okay, this is not, I'm sure this is a little intimidating, but later in the video, I'll explain what these numbers are. We're going into a live example, and I think it'll make a lot more sense, and so I worked all this out for you guys. But first, we're going to start with the basics here and reading options contracts. So again, this should look familiar. This is the contract that you just saw. So I sold a TTCF call expiring on September 17th at a strike price of $22.50 for $115 in premium. So let me explain what all that means. TTCF, this is obviously the ticker symbol. This is the expiration date right here, or sometimes called the expiry, is September 17th, 2021. This is the strike price, and you'll soon know what that means. And then this is the type of contract. So this is C for call, and the other type of contract is a put. So right now we're doing a covered call, so that says C. So the buyer's rights and seller's my obligation. So with this contract, if TTCF is at or above the strike price, which is $22.50 per share. So if TTCF is at or above $22.50 per share by the expiration date, September 17, 2021, then I, the seller, am obligated to sell the buyer, him or her, 100 shares of TTCF at the strike price of $22.50, even if TTCF is way above that price. Okay, so another way you could put this is, today is September 17th, TTCF is trading at $25 per share. The person who bought this contract can come up to me and basically say, hey, you owe me 100 shares of TTCF at $22.50, our strike price. So even though TTCF is at $25 per share, this contract says I have to sell it to him at $22.50 per share. So the reason it's called a covered call is because I already have the 100 shares of TTCF in my account. I don't have to go buy them and then sell it back to him. And it's better to do a covered call because in the case that on September 17th, TTCF is at $25 per share, that means I'd have to go buy it for 25 per share and then turn around and sell it to this buyer who bought the contract at 22.50 per share. So I would instantly, just like that, lose the difference. I would lose $250, right? So that's why it's called a covered call, because I already have these shares. So that's my obligation to the person who bought the contract, and that's the reason they would buy it. Because if they buy the call, it means they're bullish on TTCF. They think the stock will go up and probably go higher than $22.50 per share. Now, they need to buy the contract for a certain price, right? They can't just get it for free or get it for like paying nothing. So this is the contract I sold. Again, this should match right here. And I sold it for $115. Now this looks like $1.15. I actually sold the contract for $115. And the reason why is because this premium, which is another fancy way of saying the price of the contract, is actually $115. Because again, options contracts deal in lots of 100 shares at a time. So you do 115 times the 100 shares we're talking about, and that equals 115 in premium. Or in other words, the person paid me $115 for the right to buy TTCF at the strike price of $22.50 on September 17th. So hopefully this all makes sense. If it doesn't, no worries. You can always rewind or kind of play it slower. But we're going to keep going here. So why would they want to pay $115 for this contract? Because again, the seller, I'm obligated to sell him or her 100 shares of TTCF at $22.50, even if TTCF is above that price. So they think it'll be above that price. So in order for it to be worth it to the buyer of the contract, TTCF has to be over. This is a little typo. It should be 115, so 65. So TTCF has to be over $23.65 per share by September 17th, because then the buyer makes money, right? So if the buyer pays $115 in premium, now we're talking about a per share basis, which is why it's $115 instead of $115. So if they paid $115 per share basically for the contract, and the strike price is $22.50, that means that if you add those two together, if TTCF is at $23.65 per share or more, the buyer makes money because they'll buy the $22.50 from me, 100 shares at $22.50 from me. Then they already paid $115 per share or $150 for the contract. That's their total cost, and anything above that is profit for them. Now, here are my outcomes as the seller. Okay, so if TTCF is below $22.50, before we said at or above. Now we're talking about if TTCF is below $22.50 per share by September 17th, I, the seller, get to keep the premium and I get to keep my 100 shares. The contract expires worthless because you don't buy something for more than it's worth on the market. So this is good for the seller, okay? So another way to put this, right, is when they buy the contract, I immediately get that money. It's in my account. Boom, right off the bat. And if TTCF is trading at $20 per share on September 17th, and the contract gives the buyer the right to buy TTCF at $22.50 per share on September 17th, why would he want to exercise that contract? Why would he want to buy it at $22.50 per share from me when he can just go to the stock market and buy it for cheaper at $20 per share? So that is why if TTCF is below the strike price of $22.50 by September 17th, then I get to keep my shares. No one is going to want to exercise that. The contract is worthless because you don't want to buy the rights to that contract because it doesn't make sense. And therefore, I just walk away with a premium. I keep my 100 shares. And then guess what? I can write another covered call. So hopefully this makes sense. In other words, if the call option, if the price of the stock is below the strike price on the day of expiration, the call option is worth $0. So I basically, in hindsight, got paid $115 for something that is worthless. So that's why I get to walk away with the premium. But again, that's only if it's below the strike price there. So that is kind of like the dynamic of selling a covered call. And again, it's covered because I have the 100 shares in my account already. And now I think it's a good idea to move to an example here on Excel. So hopefully this all makes sense. But me, as a seller, I want Tattooed Chef to either be really close to $22.50 and like barely over 2250 or even at 2250, or I want it to be lower than 2250, but not too much lower. And let me explain why. So this is the spreadsheet that I made that basically explains how this will all work out with actual numbers and at different prices for Tattooed Chef. Okay, so there's two risks involved when doing covered calls, two risks that you need to pay attention to. So one is losing money if the stock price declines below my break-even point. Okay, and what is my break-even point? We'll get into that. It'll be explained right here. And then the second risk is missing massive appreciation or a big run on the stock via stock price. And I'll explain that as well. So let's focus on the first risk, okay? So this is the call, just to remind you. It's a September 17th call for a strike price of $22.50 per share. So this row is the number of shares we're dealing with, 100. And then this is my cost. So this relates to me specifically, okay? Me specifically, I own TTCF at an average cost of $19.33 per share, okay? So that applies to my break-even point. So because I sold the contract for $1.15 per share, $115 in premium, right? If we go back to that Canva example, I sold it for $115, right? So this is actually $115 in premium. So that's where we get this number. So my break-even point, because this premium goes directly into my pocket the second I make the transaction to sell it, my break-even is my cost per share, right, for TTCF minus 115, or my premium per share. So again, when we look at the Canva, it looks like this, 115, because we're talking on a per share basis. So you do 1933 minus 1.15, and this is my new break even. Okay, so as long as TTCF stays above $18.18 per share, I am still in the green. And hopefully that makes sense, okay? So over here, we have gain and loss on shares. And this is another great way to visualize the break-even point. So the gain or loss per share is basically calculated by taking, this is the price of Tattooed Chef on September 17th. So this is the price of Tattooed Chef on September 17th. So if Tattooed Chef is at $20 per share, right? And I bought it for $19.33, then my gain based on just share appreciation or stock price appreciation is $67. But if Tattooed Chef is at $15 per share, and if I paid $19.33 for it, then my loss is negative $433 in total on those shares, right? But then we count in the premium. So this column is my total gain loss when you factor in the stock appreciation or depreciation, the difference in stock price from when I bought it to September 17th, and then adding the premium. And the premium stays consistent throughout all of them because that's just how much I sold the contract for. So if the stock is at $18.18 and I bought it for $19.33, then just looking at the gain or loss on my shares, I've lost $115 based on this move down. However, I made $115 from the premium, and therefore my total break even is zero, right? It's at break even. So this can also be seen as my new cost basis, but that's a little too complicated for one video, so I want to keep this moving here. But anything below $18.18 per share, for me specifically, because this is my cost basis, now becomes a negative return. Because at this point, the loss on the drop in stock price is greater than the premium I received. So in this case, this is a $133 loss, right? Because it went from $19.33 per share to $18 per share and I had 100 shares. So I lose $133 on just the stock price alone. And even if you add back the $115 in premium I had, I get a negative return of negative $18. Now, that is the first risk, losing money if stock price declines below my break-even point of $18.18. Now, the second risk is missing a massive appreciation via stock price, or in other words, missing a big run on the stock. Because with selling covered calls, your maximum gain is capped, right? So But really quickly going back, actually, the reason why I'm not too concerned about negative returns here is because TTCF is ultimately a long-term hold and a long-term position for me, right? So if I am in the negative, which I'm sure many of us have been with TTCF, that's okay. I'll just keep writing covered calls. And when the new cost basis comes into play, I can write covered calls instead of a strike price of $22.50. I can write a strike price of $20 per share. But again, that's getting more into like, I guess, the more intermediate kind of strategy, or like the continuation of the strategy. But let's stick to the kind of the first few moves here. So this is the second risk that I want to explain. So this is the 2250 is the strike price, right? And we talked about this a lot at the beginning of the video. And 2250 is also my maximum gain on this strategy, because no matter what, if TTCF is above 2250, I still have to sell it at 2250. I cannot sell TTCF for more than 2250 because of the contract. Therefore, the most amount of money I can possibly make from share appreciation is the difference between buying it at 1933 and selling at 2250. In this case, that's a difference of $3.17 per share. I have 100 shares, so it's $317 gain on those 100 shares, just based on the stock price appreciating. Now you add my $115 of premium, because even if I lose my shares, I still keep the premium, and that's a gain of $432 per share, right? So the thing is, even if the stock goes to $30 per share, if TTCF goes to $30 per share by September or on September 17th, I still have to sell it for $22.50. So I'm missing out on an extra $750 of stock price appreciation, I believe, based on my calculations, right? Because what's happening is I would usually sell this for, let's see, it'd be 30 minus 19. So I would usually see an appreciation of $1,067, because that's the difference between these two stock prices times 100. However, because I have to sell at $22.50, I get stuck with that 317 gain and plus the premium. So the lost appreciation, or money I lost out on, is going to be my total return that I actually realized minus the potential return. So if I didn't have to sell at $22.50, or actually, it would be this minus this. I wonder if I did that correctly. But anyways, it would be this minus this. So hopefully that makes sense, is that essentially because I can't sell the stock for anything more than $22.50, I cannot participate in any gains beyond that point. And that's why all these numbers, gain loss on share, it's the same after $22.50, if you notice. And so is the total gain here, right? So this is this may or may not be correct here. Oh yeah, no, that is correct, I believe. Yeah, that is correct. So that's the appreciation that I miss out on. So I'm not actually losing money, I'm just losing out on money. So what would happen if the stock price dropped, and what would happen if TTCF stayed below $22.50 per share by September 17th? Well, I would collect my premium, and then what I would do is I would get my new cost basis, right? So this is what we kind of talked about here, is my new cost basis at $18.18. Well, if you take a look here, my new cost basis is $18.18. And then what I can do is, based on TTCF's options chain, the next strike price closest to $18.18 is $20. So I'd write a new contract for October 15th, 2021, a strike price of $20 per share, and it'd be a call. And I mean, I'm going to guess like an estimate of a premium of $140. So this is $115. The reason why this would likely be more is because there's more time between September 17th and October 15th versus between now, August 30th, and September 17th. So because there's more time, there's a higher premium. So anyways, you don't have to really understand that part quite yet. But it would just be the same process all over again, right? So now my new break even would be 1818 minus the premium I receive, which in this case we're guesstimating is 140 or 140 per share. So that's how you get this number right here is 1818 minus 1.4. And that's my new break even point, because my gain or loss on shares is 140, but you add the premium, and yeah, anything below that is negative returns. But now on these 100 shares, it's kind of like my cost basis for TTCF has been brought all the way down to 1678. So we're not talking huge bucks here when we're doing one lot of 100 shares, but if you're someone who owns 10,000 shares of TTCF, you can significantly reduce your position or create significant kind of passive income through doing something like a wheel strategy, which is actually something else that we have in the Discord as well. So yeah, I wanted to show like what would happen if it stayed below 2250. If it went above, I would just have to sell it, and my max gain would be $432. But if it went below, I would roll into like this strategy and just buy another or sell another call. And yeah, so the last thing I'll say is that it looks like there's kind of a narrow window here for things to work out for me, right? Because if it drops below 1818, I start getting negative returns. One, I'm not too worried about that because, again, it's a long-term hold. Negative returns is okay. And I could just go and rely on this strategy and write another call and bring my cost basis down even further. And it looks like anything above that is just missing out on gains. But in reality, from where it is right today at about $21 per share, it would need to see a 13% plus drop to reach that 1818 level, or a 7% gain to reach that 2250 level. So I'm okay with either of that, and it's really like a 20% window for this strategy to work out. And if I get exercised, that's fine, right? If I ideally, Tattooed Chef would be like right at 2250 on September 17th. I get exercised, I maximize my gain. So instead of just making $317, I make $432, right? And I don't miss out on too much. Or maybe it just sits around in this area and I just keep writing calls until I do get exercised, and I'll just keep writing calls and collecting that premium and just making that money as I wait to patiently sell this one. So I know this is a really long video and a lot more technical and probably not super like engaging, but I wanted to make a video and explain my whole strategy going on here. If you saw any mistakes or anything like that, just let me know in the comments and maybe I'll address them. I will address them in the comments, but I'm pretty sure this should all be good, and I hope this makes sense. This is a covered call strategy, and it gets a lot more complicated than this, but I think this is kind of like an introduction to how I'm using it, and also how I'm using it to trim a position. I don't want to trigger any super hardcore TTCF holders. So yeah, if you guys enjoyed this video, or I hope you guys enjoyed this video. If you learned anything valuable, do hit that like button, subscribe, and check out our quote of the day. You might just learn something. Check out Investor Community down in the description below. Again, you get access to my portfolio 24/7 here, and you'll also get access to all my buys and sells and all things like that. And if you haven't already, check out Hungry Bull down in the description below for iOS and Android. Thanks so much for watching. If you're watching this point in the video, you are the real MVP. Don't forget your peace and thank yous. Peace.